Commodity prices are surging across the globe. It's good for investors in that sector, but bad for the consumer. How bad could it be for the overall economy? That's the subject of this week's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. As we talk about the economic impact on the United States as a result of the Russian invasion of Ukraine, it is of course important to remember that the human toll is the most devastating of all. Nothing lost economically can compare. However, the financial impact remains, and the biggest impact by far has been the rapid rise of the prices of certain goods. Earlier this week, the price for nickel, which is used to make EV batteries, and stainless steel, jumped 76% in a day. It was the largest daily gain on record for that metal. Russia is a leading global producer of nickel. Wheat prices are up more than 50% since the invasion. Ukraine and Russia combined produce about 30% of the world's wheat exports. And we are all very aware of gas prices. As a result of Russian sanctions, crude oil prices have surged to over $117 per barrel at the time of this recording. That sent prices at the pump soaring. In California, for example, the average price is now well over $5 a gallon. That's a pain point certainly for consumers. Now, normally, you could adjust your household budget by cutting back in other areas. But the inflation created by war has only compounded the inflation problem we already had created by the COVID-19 pandemic. According to LPL Research, inflation expectations are rising. This gets in the weeds a bit, but short and intermediate term inflation, as measured by the 2-year and 5-year break-even inflation rates, reached their highest levels last week since 2005. The break-even rate is the difference between inflation-linked bond yields and nominal bond yields of the same maturity. Think about it this way. If actual inflation equals the break-even point, an investor would be indifferent between holding an inflation-linked bond or a nominal bond. The 2-year break-even hit 4.3%, and the 5-year reached 3.3% last week. Those are big numbers. The jump in commodity prices have certainly been a part of the overall numbers going up, but they can also be linked to a change in sentiment over the Federal Reserve's next move. The market's expectation of aggressive rate hikes this year has changed. At the start of February, the expectation was a 30% chance of a 0.5% rate hike this month. That percentage has dropped to zero now. The expectation now favors a 0.25% rate hike. In other words, the Fed may pump the brakes a little because of the global unrest. Investors have been fleeing the stock market in recent weeks already. If inflation persists or gets worse and economic growth slows, the biggest concern would be an environment where stagflation is created. Now, that doesn't seem to be likely right now. Economic forecasts are still expecting significant GDP growth this year, as well as a strong labor market. The forces driving short-term uncertainty hopefully are short-lived, and the long-term health of the U.S. economy should overcome. Thanks for watching.